And welcome to Real Deals' first ever virtual Special Situations Roundtable. I'm Talia Masiri, editor at Real Deals, and today I'm joined by Ben Slatter, partner at Rutland Partners, William De Laszlo, founding partner at Agathos Management, Jack Baines, partner at McFarlane's, Ian Caulfield, partner at FRP Advisory, and Andrew Johnson, director at Paragon International. To start, could you all please introduce yourselves, your role in your firm? Ian, perhaps you could go first.
So I'm a partner, restructuring partner at FRP Advisory. I had the pleasure of joining just as lockdown hit, so I've made an office about 3 or 4 times. Prior to joining FRP, I first started at KPMG, 20 odd years, restructuring, as a partner at Grant Thornton. I then spent 5 years out of the restructuring profession, first as head of debt advisory, corporate finance at CBRE Hotels Europe. And then I actually went out lending money around Europe for a US debt fund, looking at bigger ticket, non-conforming transactions. The one that people would most know about would be British Steel, where I kind of originated, executed, and then sat in the middle of the workout with all the government officials, etc. At the end of it as well. And that gave me a flavour for coming back into my first love of restructuring.
And Jack, if you wouldn't mind giving a quick introduction to yourself.
Of course. Morning, everybody. My name's Jack Baines. I'm a partner at McFarlane's. I head up the restructuring insolvency team at the firm. And as you can imagine, it's been a particularly active 2020. We as a team pride ourselves on looking after clients across the spectrum. So we've been very busy looking after corporates, sponsors, lenders, and particularly fund lenders is a specialism of ours, and as well as insolvency practitioners in a whole host of transactions, which I'm sure we'll get on to as the session continues.
Definitely, thanks, Jack. And Andrew, hi.
Hi, yes, Andrew Johnson. Morning, everybody. I'm a director at Paragon Insurance Brokers. I was formerly a solicitor at Squire Patton Boggs for 10 years. Started in straight M&A and then moved into more of a restructuring and insolvency role in the last 5 to 6 years. I moved across. I was previously at Marsh in their transactional risk team for the last 4 years, predominantly doing ensuring straight M&A, solvent, successful businesses, albeit in the last kind of year what everyone seems to forget about, pre-COVID, we had this thing called Brexit. So I was spending more time with former clients and advisors on how we could evolve insurance products around the distressed area. So I'm sure we'll come on to that later on. And like Ian, I started in in the middle of a lockdown. So I've yet to meet probably 85% of my colleagues. So it's all new.
Oh, wow, really interesting. Thanks, Andrew. And William, if you could give an introduction as well, please.
Yeah, thank you. My name's Will De Laszlo. I'm the co-founder of Agathos, which is a small UK PE fund focusing on UK SMEs and complex SITs. Founded in 2014, kind of Fund 1, and then we're now just moving into kind of Fund 2 at this time frame. My kind of background behind that was a little bit more of an unconventional route from leaving the military, working at JP Morgan, and then doing a MBA at Oxford, and then working for another private equity fund that does complex SITs as well, and then moved off and set up my own fund, which was extraordinary.
Really interesting background. Thanks, Will. And last but not least, Ben, hi.
Good morning, everyone. So I'm Ben Slatter, a partner with Rutland Partners. Been at Rutland since 2001, so I joined just after Rutland raised its first fund. We're a special sits fund, 263 million fund. We're investing Fund 3 at the moment. We've got 7 businesses in the portfolio and have been doing special sits investing for 20 years. So looking for good, resilient businesses, but with some complexity where we can buy at value. So we're value investing and hoping to make a big deal of difference in the businesses we invest in to drive value for our investors.
Great. Thanks, Ben, and looking forward to getting all of your views. I think we've got a really diverse and experienced panel today, so I'm keen to get straight into it. So the volume of special sits and distressed deals in the European market it hasn't been as high. I know, Jack, you kind of mentioned at the start, we kind of have had quite a busy period, and Andrew as well. But it hasn't been as kind of busy as expected since the outbreak of the pandemic. And I'm keen to understand why that is. So, Jack, have you got any opinions on there?
Yeah, I mean, when I talked about being busy, I suppose from an advisor's perspective, a lot of it has been around, particularly at the outset of the impact of the pandemic on the economy. It was primarily around some crisis management and helping clients of the firms understand where their pockets of liquidity might be, and helping directors to understand how they might navigate their duties in the circumstances that they're finding themselves in. But it is fair to say that perhaps there hasn't been as much of a volume of transactions quite yet. And certainly you look at some of the government statistics on insolvencies, and they're heading in a downward direction over the course of the year, certainly compared to the previous year. And I think part of that is just down to a lack of triggers. There's been plenty of lender forbearance, particularly with the high street lenders. Have been trying to do their best to support businesses. A lot of support in terms of liquidity from various government initiatives. Time to pay from HMRC, the job retention scheme, C bills and CL bills.
Yes.
There's plenty of reasons why businesses have been able to get by, and the exceptions to that are where you're in specific sectors, which I think we'll probably come on to. But in those sort of obvious areas that there are more immediate challenges, and that's where we've seen more transactional activity. But other things I think will probably flow in due course. We're not quite there yet.
And Ian, I saw you speak on this too. What are you seeing, and why has the special sits environment not been as perhaps busy as expected?
I think Jack's right though. We've been busy, but the imperative to make decisions has been taken away from boards of directors. So when the government, quite understandably, brought in ban on enforcement, ban on forfeiture, for a short period of time, this temporary relaxation on wrongful trading, it took the driver away from the boards to actually force a decision or to hit timetables, other than in certain sectors, which we'll talk about. So the big thing for me is we've been busy around kind of extending covenant resets, kind of what I'd call guardian angel roles, where you're talking to debt funds, equity funds, other stakeholders around what do you do if you have to.
Okay.
So I think until there's a next set of triggers, which as it stands right now, I think it's 1st of January, unless the government extends some of these provisions.
Will, as well, from your perspective, from an as a private equity investor, what kind of opportunities has Agda seen? Has it been a challenging environment for you?
I mean, we've like I think most private equity funds have kind of you rattle back and very quickly to focus on the portfolio and making sure that's stable. And touch wood, that is we haven't had any casualties within the portfolio, and only one of the businesses has taken on a kind of C-bills loan. So we're incredibly lucky. But to your point around why aren't we seeing this kind of influx of deals? I think it's to Ian's point, it's just relatively straightforward. There's been a huge kind of government-led influx of capital into the market, which ultimately has resulted in a lot of the problem businesses not failing because they've taken on loans, the kind of FOLAW schemes that have been put in place, government kind of bounce back loan schemes, all of that, and so therefore decisions haven't been needed to make, and so you're kind of going to get this kind of double whammy of kind of businesses that were inevitably going to fail because their business model wasn't correct for the appropriate market, to those good businesses that have been damaged by COVID, and who've needed to take on those loans but then need their balance sheets restructured as a result. So I think everything's being pushed out, and the latest application for example, the C-bills, that deadline has now been pushed back till the 31st of January 2021. Yeah. So again, there's more support kind of coming in, which is not a bad thing because it's ultimately supporting businesses, but it's got to stop at some stage.
Yeah, definitely. And Ben, do you agree there? Do you think kind of bank activity during this time has impacted the amount of opportunities out there for you, and will there perhaps be an influx in deal opportunities once kind of loans like the CVAs do come to an end?
Yeah, I think we've seen similar to what Will's just described. You know, early stage of COVID was a focus on the portfolio and make sure that's sort of under control. And some of the themes that have been echoed already, you know, we've seen within the portfolio. So, you know, we've had out of our portfolio 7, 3 of the businesses have covenant resets, and the banks, you know, were pretty easy to deal with and pretty generous with the covenant resets that they gave to us. None of those businesses needed extra liquidity, or, you know, so they all had headroom. It was more a covenant problem, but the banks were very swift to support in that respect. So that's been good. Some of the opportunities that we saw, you know, in the early days were actually businesses that were already failing pre-COVID. And COVID just accelerated that. So, you know, those were never going to be interesting opportunities to us. Some are very sector specific. We'll come and talk about those later. But, you know, but some of those opportunities were just businesses were just failing already. So, you know, it was already too late, and COVID just accelerated that. We're starting to see more interesting opportunities now, and I think over the next few months, you know, businesses have funded themselves by squeezing where working capital and some cash injections, and obviously the helpful support from the government. But that comes to an end. So, you know, we're starting to see more opportunities come through now of businesses that, you know, have seen through the initial sort of 6 months post-COVID, but now need longer-term solutions. Yeah,
really interesting. Jet and Ian, are you seeing companies turn to CVAs in the market at the moment?
Yeah, we have seen a lot, actually. So we were involved, for example, in the CVA of Buzz Bingo over the course of the summer, and it's proven to be a tool that a lot of businesses have relied on in order to try to deal, in particular, with issues around sort of, you know, being over rented and or needing to reduce the size of some of their property portfolio. I think, and not only are we seeing a lot of activity around CVAs, but we're also seeing it almost encouraged. So R3, for example, have, you know, the trade body have recently issued a template form of CVA for SMEs, which, as I understand it, is designed not to necessarily reduce liabilities to creditors, but more to defer. But it's setting something up which, in theory, will enable businesses to access CVAs more easily and do things in a cheaper, more straightforward way. The one sort of issue I see coming is that a lot of the deals that have happened are clearly having a significant impact on landlords, and they are getting very heavily squeezed. And, you know, there will come a point where that is just unworkable for them.
And Ian, what are your thoughts?
So I mean, my view on CVAs is that they're going to carry on. They're going to keep building. The challenge will be, as it stands at the moment, and something I mentioned earlier, is 1st of January, you only need one landlord in a portfolio to say, I've had enough, and they start winding up proceedings or forfeiture proceedings, and the whole thing will collapse like a house of cards.
Yeah.
So you might suddenly find a move back to accelerated M&As, pre-packs, or normal administrations, or credit bids, for example, where particularly, you know, the debt funds, the private credit funds are saying, enough, just give me the keys then, I might as well do it myself.
Okay, and now moving on to looking at deal sourcing. So when it comes to deal sourcing in this environment, keen to understand what are the challenges, and kind of how do you look to identify good deals, good quality deals. So Ben, perhaps you could start us off on that one.
I think that the disciplines that we always would have had to identify good deals remain exactly the same. So you're looking for good businesses, resilient markets, you know, and the opportunity to make a difference. What is challenging now is just making the financial assessment of some of the situations is just going to be more challenging given impacts of COVID, either positive impacts or negative impacts on the performance of the businesses. So, you know, we're starting to see information memorandums sort of come through on businesses, and information come through, you know, with the classic COVID adjustment, adjusted COVID EBITDA, and some of them are quite laughable, the presentations that are being sort of put forward.
And Will, have you got anything to add on this?
I add to that in terms of our Fund 2 really is pivoting from operational distress, which is much more focus of Fund One, is to balance sheet corruption, as it were. And Agathos Fund Two is finding good businesses, but predominantly actually good management teams. And that's those are the businesses that we are really excited about backing, because they've either by hook or by crook managed to get their way through this complete anomaly in our lives. And those are the guys you want to be backing. And that's what we're kind of, I suppose, super excited about.
What sectors have faced the greatest headwinds during this period, and how long will they continue to face these for? Ian, perhaps you could start on this.
I think the first thing I'd say is there's a genuine risk we're going to see round two on the deals that have already gone through.
Okay.
So, you know, we've if you think about a CVA that's gone through on the basis of this is what the forecast will look like, we now have a 4-week lockdown, but then the next day politicians are saying could be longer. Then, you know, and if you're a leisure business, imagine a swimming pool, a gym, a golf club, or whatever, and you don't know A, when you can reopen, and B, what's the mood of the uptake from your members. Then there's a big hole in your finances from what you've already agreed. So you may have to go back and do it again. But we actually have a CVA, fairly sizable CVA, where we're having to potentially go back. Only went through on Friday. So I think we could see round two, or we could well. The other thing we've seen is conversations with purchasers on accelerated M&As, where the plan would be to buy the business potentially solvently, and then CVA afterwards, get control, CVA it, to try and do the restructuring in the way they want to do it. So that's quite interesting. In terms of sectors, I think, you know, we'll still see more casual dining and similar venues like that. Hotels coming. I've had 3 sizable inquiries in the last week, or tip-offs in the last few weeks. But if you move away from leisure and hospitality, I think that having been a lender for the last 3 years and looked at a number of acquisition opportunities to kind of broaden the portfolio, I think there's a lot of, I don't mean this derogatorily, but subscale alternative lenders, whether asset financiers or ABLs, things like that, who haven't quite got the scale and the first loss buffer to survive what's about to happen. They haven't got the experience of LGDs and bad debt and things like that.
Okay.
Peer-to-peers, I can see having a problem. Everybody knows. I think retail's got a different problem. Well, it's got more than one problem, which is obviously the landlord structures. But I think there's a slow shift to different buying patterns anyway. It's whether this has accelerated it. So the winners will be the ones that grab that. And then I think we're going to start to see some infrastructure things like oil and gas, things like that, because we've got a new demand level which nobody understands at the moment.
And then when it was flipping that on its head and looking at kind of areas that are attractive at the moment, Ben, and then perhaps Will, if you could follow on from this, what areas are you considering?
So, well, I mean, we're a special sits investor, so we like the complexity. So inevitably, we're going to be drawn to businesses that have had some level of disruption as a result of this. And you know, it's interesting going through the sectors that have been, you know, I was on the call saying disrupted. You could add more to that, you know, aerospace supply chain, automotive supply chain, and then the ripple out of impact on suppliers to all of these sectors will go across a whole swathes of, you know, SMEs across the UK. So, you know, there's situationally will be lots of opportunities in sectors. I think there's clear sectors for us absolutely to avoid, where it's so difficult to, you know, understand what the demand looks like and, you know, the impact over the next few years. But you know, we're opportunistic, and you know, we'll look at anything that comes along. It's very easy to just dismiss some of these things, but actually there's others that are interesting. You know, we've just sold a business that's in the pet sector, and it sells into grocery retail, and you know, the business is double-digit like-for-like growth, and it had an awful lot of interest. So you know, there's businesses that are doing well out there, and it had a lot of interest because it's shown some resilience and it's got growth and it's had a good team. So there will be more mainstream players really going after those sorts of businesses.
From our perspective, it's like we look at it and kind of go across the board. There's been, you know, as guys are saying, hospitality, hotels, events, retail, leisure, schools. We've seen a few schools through peer-to-peer lenders. Landlords are going to be disrupted. Then you move into the manufacturing space. It's just like it's carnage. And this comes back to really trying to pare back, finding fundamentally good businesses with good management teams, and backing, as Ian was rightly saying, it's actually backing those management teams.
And Andrew, what sectors have you been seeing increased activity in?
I can say, Talia, I know certainly from when we're insuring kind of successful businesses, i.e. the solvent ones that are doing well, where they haven't had, as Ben and Will would say, in terms of disruption. There's, I guess, there are three sectors we have done a lot of deals with, and certainly the last 6 months have particularly been in logistics and the software around logistics, technology that supports it, and healthcare and life sciences deals. We've had a huge uptick in those. And so they're kind of sector areas that we have seen have been, have done very well in COVID. Going back to this, I think we can't ignore some of the big headline cases in the retail sector. So clearly, as we've already discussed, the retail sector has been hit considerably. But what we've noticed is a number of high street brands have continued to receive equity injections. So obviously we've got New Look, as we mentioned earlier, Hunter Boots, we've got Dutch retailer Hemmer, as well, all of which have received these equity injections. So why is this taking place? I'm keen to understand that. And is it purely to protect their returns in the long term? And what are the dangers of acting in this way? Ben, have you got any views on this?
Well, we over not in the last 6 months with COVID have we had to put equity into businesses, but we have done in the past.
Yeah.
And you put equity in where you believe in the business and you want to protect your position, and that's either driven by a need for cash or a discussion with the banks who are getting aggressive on you and want to be delevered. And you do that. It's always the judgment of putting more money in. Are you putting good money in after bad, or are you putting money in to support a business that's eventually going to deliver a return? And you have to look at a return on that investment, very specifically, to understand, is that a good decision, or not, and you're doing it to support your investment.
Jack, what are your thoughts on this activity?
We're also seeing motivation driven by other external sort of influences as well. So you see, for instance, in say the travel sector, the CAA is keeping a very close eye on a lot of businesses, obviously having been burnt by some of the high profile collapses over the last couple of years, and so they're very focused on making sure that businesses are well capitalized and able to get through what's going on, and the threat being that if businesses don't have enough liquidity for their liking, that they'll remove their license and stop them from selling holidays, for example, which is catastrophic for that sort of business. I
think an area that has kind of been very active during this time has been the carve-out deal sector. So I'm keen to understand, Will, are carve-outs coming from companies in sectors facing headwinds, or have you seen any other opportunities in different sectors that were interesting to you?
So yes, we have seen quite a few starting to come through, and I think that will increase. Businesses potentially that were bought by a larger group that maybe they're deemed as non-core or kind of refocus, reflecting back. But that's a tough place for a large corporate to be in, because they're selling it into a down market essentially.
Yeah.
Arguably, you could say, well, yeah, fine, they're raising cash to protect the core business, but they're in a weak position, and so therefore, kind of why sell unless you have to, and or unless you're in a sector that has been unaffected or is a booming sector as a result of the tragedy that has happened over the last year.
Yeah.
So yes, we are seeing a kind of an increase in that, and I imagine it will increase as capital becomes more constrained, and large corporates are looking for further resources of capital to sustain the centre of the company. I think we're going to have 5 million people unemployed by January, February, potentially next year. And then that's going to have a knock-on on consumer confidence, which is going to have then a further impact in terms of businesses that are struggling to survive at the moment, maybe quality businesses, but struggling to survive, and if consumer confidence is hit, and so their buying power is then or the consumer's ability or desire to go out and buy products is diminished. So yeah, it's pretty.
Certainly. Yeah, I do think it's pretty worrying, and the impact that this is likely to have. But I guess that's where private equity firms will hopefully be able to come in and save the day and actually find those quality businesses and keep them going where they can. And now, just I'm concerned about time, so just we'll move on, and then I'll kind of run through the questions per person. In terms of transaction risk, so Andrew, I know this is a point where you specialise in as well. When it comes to distress and special situations transactions, what transaction risks exist, and what risks do managers need to be aware of, especially now?
Well, I think the direct answer is kind of risk in every transaction. How you can mitigate that risk is the evolution of insurance and where we're currently at in terms of the kind of, if you're splitting up the risk in a transaction, and how they're covered off under insurance. In terms of unknown and unforeseen risks in a business, that's ordinarily covered off in kind of warranty and indemnity insurance policies. But likewise, where a risk comes through in the due diligence or disclosure process that's known about, or there's a risk that it will crystallize post completion, that's taken care with contingent risk policies. And so often where we work is working with a combination of them both, dependent what is driven out in that due diligence process. In terms of, I guess, the evolution of where we're at is, in terms of the solvent successful M&A business, it depending on who you get your data or stats from, it's anything between 60 and 70% of all deals are now insured. And that's a kind of combination of competition amongst insurers. I guess when I was still in practice, I think there was maybe 6, maybe 7 insurers who would look at a deal. Now, as of last week, it's 29 different insurers. And that creates 2 things. It kind of creates that competition, brings the price down, so it makes it actually price worthy, and it also means the coverage position is better. I guess 10 years ago when deals were first insured, it was expensive and fundamentally it was crap. I mean, as a lawyer kind of advising on these deals, you would think, well, what am I actually getting here? That evolution has clearly changed an awful lot. And I guess there's also the kind of commercial awareness of where it works and where it doesn't, which is fundamental. And I guess confidence in the products. Insurers are now paying out on claims, and sizable claims, and that confidence is now filtering through. In terms of distressed deals and how that's kind of evolved over time, obviously the general M&A fell off a cliff in March, April. You got these 29 insurers. They all it's a risk reward ratio. They all want a premium of some form. When you're down, just like every other business in this situation, they're all looking to innovate and find premium elsewhere. I guess those ones, I've been talking to last year in terms of the distressed area. There are some innovative insurers, and fundamentally, probably more importantly, lawyers who are working there who have a background of restructuring insolvency and understand the parameters, understand the risks, and are being more commercial.
Just moving on to now, I'm keen to get all of your views looking to the long term. Firstly, I know we kind of mentioned it before in terms of the government support, and once that slows, will it be easier to identify attractive special situations opportunities? So Will, what's your view on that? When
the government schemes come to an end, I think we'll see a massive increase in the number of opportunities that are starting to come through. In terms of how easy is it to identify good opportunities, I think that we were talking about risks a second ago. The big question, I think, for all of us is, well, what does the new normal look like? And that's the underlying one of the huge underlying questions that we ask when we're looking at kind of new opportunities, because I think we're going to see a cultural change in the way we work, and the ramifications of that could quite easily spread across so many different sectors that we don't really understand the kind of full impact of that. So yeah, I think in light of, I think there'll be more opportunities coming through, and how we evaluate and identify those opportunities is challenging, but we'll work through it.
Yeah, definitely. And do you agree, Ben?
Yeah, I agree. I mean, the question's sort of in 2 parts, isn't it? Is one, what's the volume of special sits, opportunities, and then your question is about how attractive are they. So I agree with Will, there's absolutely going to be a significant volume of them, particularly when the government support initiatives end. And then the attractiveness of them is, how able are we to assess them? So an element of stability, so with a bit more passage of time, you can see where these businesses are adjusting to in terms of the Will's term than sort of the new norm. So they'll be easier to assess. So there will absolutely be more opportunities, and there'll be a lot of work required to sift through them and identify the ones that are really interesting. But with time, we'll be able to assess them easier.